Hello, this is a video on question number 14, which is on page 261. And this is one of the last few questions in foreign income topic. So Heartbreak Enterprise Private Limited, HE, is a Singapore resident company and has a 31st March year end. And it holds 15% of interest in the share capital of Qn Limited. So there are two companies involved here. A company resident in Republic of Independent Souls. So the other company is in another country, and on 12th of February 2018, JL paid HE a gross dividend of $50,000, the amount of which was credited into the HE bank account in Singapore on the same day. So to understand what is being read so far, let me draw a picture of the situation. So we have HE, and HE is the Singapore resident company. Okay, and we have this company owning JL Limited, okay, which is in the country of Republic of Independent Souls. Alright, this is a situation. Now, according to the question, it says that the Singapore company HE owns 15% of JL. Now, is this 15% important? Well, we'll tell you in a while. So now, HE Limited has a 31st March financial year end. Okay, and according to the question, on the 12th of February 2018, 50,000 worth of dividend was remitted back to Singapore. Okay, now a one-tier corporate tax system applies in the Republic of Independent Souls in respect of a dividend paid by JL. Now, if you still remember what is the meaning of one-tier corporate tax dividend, which means that, right, there is no tax on the dividend. In other words, as far as dividend is concerned, there is no withholding tax. Now, if you still remember what we have covered previously in a previous question, the difference between the underlying tax and withholding tax. So withholding tax is actually called the tax on dividends. So if there's one layer of tax, one tier tax structure, one tier tax system, which means that there will not be any withholding tax here. So which means to say that HE does not suffer any withholding tax, and if they do not suffer withholding tax, you will not be allowed to claim any relief on this layer of tax. Right, so let's go back to the question again to read. So accordingly, the gross dividend of $50,000 was exempt from tax in the Republic of Independent Souls. However, corporate tax at an effective rate of 10% had been paid by JL underlying profit, which means that there is actually an underlying tax of 10%. And as you know, an underlying tax is actually the corporate tax rate. So they did suffer one of the two layers of tax, if you still remember what I have shared with you previously. So let us go back to this part of the question here. So which means to say, now if I were to write in this manner, right, so if JL earns profit, they will need to pay corporate tax, and the net figure will be what we call the PAT. Since there is no withholding tax, alright, the net amount that will be remitted back to HE will also be equal to the PAT. Right, so if I work backwards, alright, to find out what exactly is the profit that is earned by JL, it should be 50,000 here, and this figure is in fact the very same figure that you see on the top part here. Okay, so there is no withholding tax. Now, according to the question, there will be a 10% of corporate tax, which is what we also call the underlying tax. So, which means to say that if I were to work backwards, right? Okay, so this will represent 90%. So if I regross it back to 100%, the tax that they would have paid will be 5,556. As a result, the profit that they actually earn will be 5,556. Right? So I hope you have a better idea of what's going on. Now let us look at the first part of the requirement. Okay, it says, now part A, it asks, state the reason why gross dividend income of 50,000 is sourced outside Singapore. All right, 1 mark only. If it's a 1 mark question, please do not write too lengthy. Now the reason why this dividend that is earned by HE is considered as foreign dividend, because if you still remember what I told you, we look at who is the company declaring the dividend. Since the company declaring the dividend is a non-resident of Singapore, then the dividend that they declare will be foreign dividend, foreign source dividend. Now, how do I know that JL is non-resident in Singapore? Because they are, according to the question, it was mentioned that the company JL is a resident of Republic of Independence. So according to tax rule, right, most of the tax jurisdiction, or rather, they will not allow a company to be tax resident in 2 places, right? Usually, it is only 1 place that they will allow you to be a tax resident, right? No tax jurisdiction will allow you to be tax resident in more than 1 area. All right, so if you're tax resident in 1 country, you should not be a tax resident in another country at the same time. So that is what I actually mean. All right, so how do I know whether the dividend is a foreign dividend? Okay, so JL is a non-resident company in Singapore. Therefore, the 50K dividend is sourced outside Singapore, right? So that is all you need to write for part A, which is only 1 mark worth of question. Okay, now let us go back to part B, the requirements. State given reason, the Singapore income tax implication pertaining to the dividend received from JL on the assumption that the headline tax, corporate income tax in the Republic of Independence is part 1, 35%. So assuming that JL has a headline tax of 35%, will the dividend income earned by HE be exempt from tax in Singapore? Okay, so if you really want to find out whether the income will be exempt from Singapore and if it's a foreign income, always remember to look at this diagram, right, to find out if the foreign income received by a Singapore resident company is exempt from tax or not. So let us go through this a few times. You really get the hang of it. So well, okay, so first question to ask is the income received in Singapore? Yes, according to the question, it was received on the 12th of February 2018. Is it received by a resident company? Well, yes, because Heartbreak Enterprise is a Singapore resident company. Now, is the dividend they receive one of the income here? Yes, it is a foreign dividend. So the next part is, are all the conditions here satisfied? Okay, headline tax, is it more than 15%? Well, yes, according to part B1, the headline tax of Republic of Independence, so it's 35%, so you pass. Do you suffer foreign tax? Yes, because JL already have paid tax, which is the underlying tax in the other country. And the last condition, we will assume that it is met. So that means to say you would have met all the conditions in section 13.8. So in this case, the dividend income will be exempt from tax in Singapore under 13.8 and 13.9 concession. Okay, so now I know the answers are provided at the back of the solution, but it is good for me to go through this with you so that you have a better understanding on what's going on. So if the headline tax is 35%, the income will be exempt under section 13(8) and 9. Now let us look at the second situation. Will it be different? Will the outcome be different if the headline tax is now 10%? Well, you should know by now. Alright, if the headline tax is only 10%, you would have failed this condition here, right? So if you fail this condition here, that means we will say that the foreign income will be taxable when it's received in Singapore. Okay, next question is there double taxation? Yes, because there is already tax suffered in Republic of Independence. So, and now when you want to remit back the income in Singapore, you have to pay tax again. So accordingly, there is a double taxation. Alright, however, in this question, they only suffer underlying tax. They did not suffer withholding tax. So if you allow them to claim a relief, which is a credit method, you can only claim relief on the underlying tax that they suffered, which is the $5,556. Okay, so how would you want me to write this answer? Okay, now, so if the headline tax is 10%, all right, can you claim a relief? Credit relief. Now, if you go back to the question, it says, well, there is no tax treaty between Singapore and Republic of Independence. So, if there's no tax treaty and if you really want to claim a tax credit, let's see whether you can claim under UTR for corporate tax or not. So, if you still remember the diagram that we have seen on page 260. So if you want to claim relief on underlying tax and there is no DTA, you will only be allowed to claim UTR if HE, Heartbreak Enterprise, owns 25% shareholding of GL Limited. But as far as this question is concerned, I think HE only owns 15%, which means to say that you fail this condition and you will not be able to claim any credit relief for underlying tax for part B2. Okay, so now, however, there's a way out. In the event if you're not able to get the shareholdings condition satisfied, you may be allowed to get waiver by minister. However, if this is not granted, in the end, you may want to consider using deduction method. So if you're using deduction method to claim a double tax relief, remember you have to put in the net figure instead of the gross figure. Okay, so now in this case, you cannot claim HE, all right, cannot claim the credit relief for the underlying tax suffered because the minimum 25% shareholding condition is not met or satisfied. But Heartbreak can try to get minister waiver on the shareholding condition. All right, however, if it is not approved, you will try to claim under the deduction method for the double tax that was suffered. on the foreign income. Okay, so that is for part B2. Now, how about part B3? Will the outcome be different? Let's look at part B3. Now, it says the headline tax will still remain at 10%, but HE, instead of owning 15% of JL, it now owns 30%. Right, so if you own 30% of the other company, which is this part here, which means that you would have be able to meet the shareholding condition that is stipulated inside this on this page, right, of 25%. So you would have met the 25% shareholding. In this case, you can in fact claim a tax credit relief under UTR. Okay, so if you're allowed to claim a double tax relief, credit relief under UTR, how would you write out your answer? Okay, again, the answers are actually provided at the back, but please allow me to go through this with you so that you will have a better understanding on how to interpret the solution that is provided at the back. So HE can claim credit relief under UTR on the underlying tax suffered, because the shareholding between HE and JL is more than 25%. Okay, 25% is a minimum if there is no DTA. So in other words, if you're required to do the calculation, it will be lower of the foreign tax that was suffered in Republic of Independence Seoul, or the Singapore tax amount that will be payable on the 50K dividend. So foreign tax that is suffered is actually what we have figured out here in this simple calculation, which is 5556, right? However, we are not sure how much tax will be paid on the dividend in Singapore, because there is no other further information provided in this question pertaining to HE. So with this will be the answer for question number 14. Thank you.